Hey everyone, welcome back to the channel. Today we're diving into a topic that can make or break your mortgage approval, your debt to income ratio. I know it sounds complicated, but don't worry. I'll break it down in simple terms and show you how to calculate it and explain why it's important. So, your debt to income ratio or DTI compares how much money you owe each month to how much money you earn. It's used by lenders to see if you can afford your mortgage payments. So a simple way to calculate DTI ratio is monthly debt payments divided by gross monthly income multiplied by 100. Lenders look at your DTI ratio to decide how much they can safely lend you. The lower your DTI, the better your chances for getting approved for a mortgage. Why? Because it shows them you have enough income to handle mortgage payments and still handle other expenses. There are different kinds of DTIs. Number one is front-end DTI, which is also the housing ratio. This includes your housing costs like mortgage payments, property taxes, insurance. Most lenders like to see this at 28% or lower. Number two, back-end DTI. This includes all your monthly debts like car payments, student loans, credit card payments, plus your housing costs. Lenders prefer this to be around 36 to 43%. Let's say your monthly income is $6,000 before taxes and you have these following monthly debt payments. Car loan, $300, student loan, $200, credit card payments, $100. Your total monthly debt is about $600. So now, let's calculate the back-end DTI ratio. Here's the calculation. With a DTI of 10%, you are in a strong position because your monthly debt is low compared to your income. But this is your DTI before buying a house. And let's see what happens when we add a potential mortgage payment. So now, let's add a mortgage payment of about $2,000 including taxes and insurance. New monthly debt will include existing debt of $600, monthly mortgage payments of around $2,000. So your new total monthly debt would be $2,600. Looking at the new DTI calculations, now you are up from 10% to 43%. This is at a higher end of what lenders consider acceptable. Some lenders may still approve your mortgage, but others might say it's too risky. Here's a quick guide to what's considered a good DTI ratio for your mortgage approval. Excellent is 20% or below. Good is 21% to 36%. Manageable is 37% to 43%. You may need a strong credit score for this. Risky, above 43%. Your chances of approval decrease significantly. If your DTI ratio is too high, don't worry. There are ways to improve it. Firstly, focus on paying off your high interest debt like credit cards. Even a small reduction in debt can lower your DTI. Secondly, increase your income. Consider getting a side job or negotiating a raise. More income can lower your DTI ratio very quickly. Third, avoid new debts. Don't take on any new loans or make larger purchases when you're applying for a mortgage. This can make your DTI worse. Next, choose a more affordable home. If your DTI is too high, you may need to look for a home with lower monthly mortgage payment. Now let me tell you about my friend. He was excited to buy his first home but had a DTI ratio of about 50% because of his student loans and car payments. He was denied a mortgage. So he focused on paying off his car loan early. After 6 months, his DTI dropped to about 35% and he got approved for a mortgage on a home worth $400,000. This shows that improving your DTI ratio can make a huge difference. Your debt to income ratio is one of the most important factors when applying for a mortgage. A lower DTI means better mortgage options and less financial stress. Before you apply, calculate your debt to income ratio and see where you stand. If it's high, use the tips we discussed to improve it. If this video helped you, then hit the like button and subscribe for more home buying tips. And tell me in the comments what's your biggest challenge when applying for a mortgage.